The price of crude oil collapsing today as U.S. refiners ramped up output, but the pain at the pump continues as the average price of gas rose to a record $4.56 a gallon, according to AAA, and prices driving even higher in California, the first state to ever record an average gasoline price of $6 a gallon. So how long can these inflation pressures last? Let's bring in Ed Morse, Citi's managing director and global head of commodity research. Ed, do you think there's some relief in sight before the summer ends?
I do, absolutely. And I would note that while we had pump prices going up, we had the screen price going down today. And I think that we're going to see more momentum with more red numbers on the print every day. And I think the summer we'll see a lot of relief.
How much relief are we talking about? And is part of the dynamic that, you know, at $6 a gallon in California and more than $4 everywhere else in the country, that there is some demand destruction going on?
There's demand destruction going on, and there's more supply in the market than people have been thinking, and more supply of gasoline coming. Asian refiners, Indian refiners are now starting to export gasoline to the U.S. market, and we'll see a lot more of that happening. But really, it's the crude price. If we look at supply and demand balances, and we saw crude sell off to $109 today, we expect prices this quarter to average $99, a good $10 below where they are, and that's because we think that the price drops will be considerable by the time we get to the end of June. And then when we get into the July-August market, even though it's a higher market for summer driving, we think the supply-demand balance will bring the price of crude down to the lower 90s by the end of the summer, and then to the under 80 by the year end. You get a drop in prices of crude by 20%. That should translate into a 20% more or less drop in the price of gasoline at the pump, along with it with a bit of a lag.
Hey, Ed, it's Brian Kelly. So I'm curious where the disconnect is between your forecast and some of the producers like Pioneer saying for years you're going to have $100 barrel oil. They seem to be, they're the ones pumping it out, and they're on the front lines. What are you seeing that they're not?
Well, I hate to pick on a company, whether it's Pioneer or some other company. If you look at the spread of forecasts across companies, take the majors, they're all up a lot lower than where the one independent company is that you were saying. Nobody knows what the future is. We do know that the forward curve, at least directionally, is a pretty good indication. And the forward curve is going down in a very strongly backwardated market, which would indicate that something is lifting the prompt price that's temporary and not a good indicator where the prices are going ahead.
So, Ed, I see in the pre-interview notes, you think the macroeconomy is getting worse or more gloomy every week. That's your word, gloomy. And so I'm wondering what your outlook is for some of the metals, particularly industrial metals at this point. Obviously, there's a supply side element and a demand side element. You think the demand side might abate. What happens to the other side?
Well, the supply side is going to respond in kind. We have a bit of noise in the metals markets because of so many metals being tied to exports from Russia. But if you look at China, the world's largest consumer of metals, and you look at the most robust forecasts of growth in China, picking up from where things are now, we're looking at an inventory build, certainly through halfway through the year, and then who knows? So we've got Q2 prices now at a level that is lower than we thought they were going to be. We think that's going to continue on into the fourth quarter. Maybe we'll get a little bit of a boost in aluminum from $2,800 a ton to $3,200 a ton. Copper, we think, is going to stand still. Definitely on the nickel side, we think that that incredible artificial run up to $110,000 a ton, now trading at around $26,000, not quite back to the $22,000 we were at the beginning of the year. We think by the end of the year, we'll see that further erode, so that nickel will be pricing back down at that same $22,000 a ton level. And zinc, which has been especially tight in that energy-intensive industries, and zinc smelting in Europe have shut down. But we think zinc will be short-term, not going very far, ending the year a little bit lower than it currently is, and ending next year at this time about 10% lower than it currently is.
All right. Ed, thanks for sharing your forecast with us. We appreciate it. Ed Morse of Citi. Jeff, where do you want to go in this trade in terms of energy or metals?
Yeah, I mean, let's look at energy for a second, just because, number one, it's been consensus for so long, and it's probably still overbought. So look at a name like Chevron, for example, still trading 26% above its 200-day moving average. But I'm still in the camp that you want to buy weakness there. I mean, I'm not a commodity expert, but I was under the impression that heading into this year, spare capacity was very low, and now the situation with Russia has made that worse. So my guess is, even if prices are 90, 95, 100, 110, these are still levels where a lot of these companies are quite profitable, and you could make the argument that Chevron's at an all-time high or near an all-time high, but it's still only trading at 11 times forward. So, there's value in these names, technically overbought, but buy the weakness, because I do think that there's more room there.
I feel like you have to sort of, I agree partially with what Jeff's saying, but I think that you have to sell them at this level. Ed's talking about less than $80 a barrel.
Well, you're Mr. Recession, so obviously you got to sell all
And
this.
I also think that oil is going to be at $65, so that's less than $80. So I'm in agreement with Ed. But having said that, you haven't been rewarded. Look at the XLE, up 47% year to date. You have not been rewarded by buying individual names. It's not worth the risk. So if you think energy is going higher, stay with the XLE. If you think like Ed does and I do, and I don't want to speak for him, like I do, I think you want to be selling these names that have rocketed higher. It's been all about positioning, being all offsides.
Tim, what would Tim do?
Tim's going to be buying energy.
Well, Tim has been investing in resource and energy stocks much of his career, because that's a core part of the market cap in places where I've made a living. I actually think that energy is now an investment, not a trade. And I actually think you don't need $120 energy. In fact, you probably don't want it if you're one of the producers. They're break even at 45. We talk about the free cash flow dynamics. I think the entire commodity space also, we should not blanket it. I actually think steel prices are coming down. I actually don't want to own steel companies here. I think aluminum companies, and I think Alcoa probably has a bid here. I love gold, and we've forgotten about uranium, which now you're back at the bottom end of the range over the last 6 months, and we couldn't stop talking about uranium for months. I'm still interested in uranium just because the market's not. I think you've got dynamics here which are long-term and structural, and there are reasons to own some of these things, and you should not treat the entire asset class the same way.
Just quickly, BK, who do you believe, Ed Morse or Pioneer, when it comes to oil price forecasts?
With all due respect to Ed, because he's a great analyst, I'm going to go with Pioneer, because I think there's a structural issue going on in the oil market.